Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 27th, 2024. I hope you're doing really well. I hope you're having a nice weekend. I appreciate you coming here and watching my weekend review podcast. In this podcast, the format is going to be as follows. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions and all the trades that I made last week. We're going to talk about when I bought them, why I bought them, which setup I was using, which strategy I was using, and most importantly, how I am going to manage the trade going forward. Identify my stops, identify profit targets when I get to trailing stop level, and just basically how I'm going to manage the trade going forward. That's the most important part. Once you have no control over anything after you hit that buy button or short button if you're going short, but you have full control up until you get in, and then after that, the market's going to do what it's going to do. But you need to know what you are going to do, regardless whether it goes your way, whether it goes against you. You have to know, if it does this, then I'm going to do that. If it does that, I'm going to do this. It's very, very important. I talk about it every week, how important it is to have a process. And there are many different processes out there. I use my process that I've put together over the last 28 years as a full-time trader. But there's many, many different processes, but they all come down, the good ones all come down to buying at support, whether that's different price levels or moving averages or RSI levels, position sizing correctly based upon the volatility, and most importantly, having a good risk to reward ratio. If you're wrong quick, you're wrong small. If you're right, you have a process to stay in the trade so that you have the possibility about having an outsized gain. You're going to have, I lose all the time. But when I lose, it's generally small. And when I win, it can be small, but every once in a while I'll have some really big wins, and that's what's most important. You have to have some big wins to pay for all those little losses. That you have something left over called a profit, right? So I hope you're going to enjoy that. Kind of give you a peek into how I trade and what my process is. But I recommend very, very highly that you get yourself a process that incorporates the things that I just talked about. All right. After that, we're going to talk a little bit about trader psychology. Most important skill in trading is the ability to create a plan and follow it, and that comes down to trader psychology. So we'll talk about that. And then we are going to take a look at my potential trades next week. On the weekends, what I do is I go through my master watch list, both on the daily time frames and the weekly time frames, and identify different markets and certain levels. They're not there yet, because if they were there already, I may have already taken the trade. But I look and go, okay, XYZ stock, if it comes down to here, that would be a good level. There's some key confluences of signals down here. And so it's a waiting game. So I've identified, I think, 8 on the daily, 4 or 5 on the weekly, of the locations that if they get there, things would make sense. Good risk to reward ratios, multiple confluences and combinations of indicators lining up. So it's really a patience game of just waiting for a market to get there. If it does, then I can consider to take the trade. If it doesn't get there, I'll just wait until something gets to where I want it. It's just being patient. It's like standing, playing baseball and standing in front of a pitcher and just being able to wait for that perfect pitch. Well, in baseball, you can't wait too long because you get 3 strikes, right? But in the market, you can wait for that perfect setup to get there. And that perfect setup may not work, but hopefully if you position the size correctly and you have a good risk to reward ratio, if it doesn't work, then you're out quickly. But if it does work, you have the ability for an outsized gain. So anyway, if you like today's what we're going to discuss today in today's podcast, and I hope you do, I would really appreciate it if you could hit the thumbs up button. If it shows, if you've learned something in value, really does help out the channel. Lets YouTube know that there's some valuable content here. All right, so if you do, I really appreciate that. So let's get started. I'm going to run the U.S. legal disclaimer, and I'll be back in about 42 seconds. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. Let's take a look at PayPal. So I shorted PayPal back here on the 8th of April. And what was my thinking? Well, my thinking is what you can see, this highlighted blue box here. This is called a bearish fair value gap. So what makes that a fair value gap? Well, what happens is you need to wait for a change in structure to the downside. So this is all very positive on the way up here. We have a high, we have a little pullback, we make a higher high. And then you can see here on these two bars here, after going up, we take out this first swing low. This changes it into a bearish fair value gap. In other words, it changed the structure from up to down. And when you change to the downside, you'll often get a rally up before you head back down. And the highlighted blue area here is called the fair value gap. And this comes from ICT. You can look up ICT on YouTube. This is not my own strategy. This is something I learned about that I've incorporated into my trading over the last year. It's really good. It really is good. But the blue box here consists of 3 bars. Bar 1, 2, and 3. I take the low of bar 1, the high of bar 3, and you can see this is the blue shaded area. So again, we're going higher, higher, higher. We move down strong, break this swing low. That turns us into a bearish market structure. So if you're in a bearish market structure now, you want to short the rally. So I short the rallies that come back into the fair value gap. I shorted here at, let's see, what is that? 66.50 at the top of the fair value gap. My initial stop is a close above this high here. Next day moved against me, but then we had this nice big down move. So when I enter a trade, I always position size first of all. Very important, position size based upon the volatility of the market and your trading account size. And what I do is I take 1% of my total trading capital. I divide it by the value of the 2 ATR. That shows me how many shares to buy or short in this case. And then I have 2 stops. I have a end of day stop, which on a fair value gap would be a close above the previous highs close, because then it would change the market structure back to bullish. And then I have a emergency stop, 2 ATRs. Remember, I took 1% of my capital, I divided it by the value of the 2 ATR, show me how many shares I'm going to buy. And then from my entry, I go up exactly to ATR. So if it gets to that level, then I have lost 1% of my capital. But that only happens about 5% of the time. 95% of the time, my end of the day stop, which is much closer than my emergency stop, will take me out. All right. So I got short here at 66.50. I know where my end of day stop is. I know where my emergency stop is. Now, as soon as I do that, then I mark what's called a trailing stop level. And this is 1.5 ATRs below my entry. Once it gets there, then I go into what is called trailing stop mode, which all that means is, if in a short position, all that means is now, once I get there, if I get a close above a previous bar's high, because I'm short, then I will exit half of my position, lock that profit in, reduce my position size. And so it basically, you just move up all your stops by covering half or selling half. And then the last thing I do, everything I've talked about, the position sizing based upon the volatility, the end of day stop, the emergency stop, the trailing stop level, these are all defensive moves. But I like to play offense in my trading as well. And the offensive part is taking partial profits when the market provides those to me. And so how do I do that? What I do is I take the closing price, like right now the closing price is 65.96. I'm short. And then I look at the value of the 0.45, which is 73 cents. So on Monday, I will take 65.96 minus 73 because I'm short. That will be my first profit target. I'll take my first profit target minus 73 cents from that. That will be my second. Take my second minus 73 cents from that. That will be my third. So every day, if I'm short, it's 3 profit targets of 0.73 minus my minus the closing price of the day. If I'm long, I do the opposite. I take 65.96, add 73 to it to the upside. So if I'm long, I always have 3 profit targets above. If I'm short, I have 3 profit targets below. And this is a very, very important part of my trading. In my opinion, having to play offense and defense is, you have to do it, because you can have these nice big gains and that just get reversed and take it all the way away from you. But the way that I do it, if I have a nice big up move, I'm taking profits, taking profits, taking profits. So it does come down. I've mitigated the loss. I've locked in those profits, and it really adds up over a year. So again, starting over, we have a high, pullback, higher high. We have a change in market structure. We identify the fair value gaps. I got short here at 66.50. Now, as it moved down, next day moved down enough for 2 profit targets. All right, so I take partials off. Next day, not much. Next day, we go down again. I continue to take, I took 1 profit target here. Next day, we go down again. I take another profit target there. I'm continually locking in profits and reducing my position size. On this particular day, we got to trailing stop level. So now, going forward, if we have a close above a previous bar's close, I will take half of whatever the remaining shares are. Next day we go down a little bit more. Next day we go down a little bit more. Next day we go down big. What did I do? I took more profit targets. I kept reducing my position size. Next day we went down enough not for a profit target. And then here on Monday, this is the first close above the previous bar's high after reaching trailing stop level. I took off half of the remaining shares for a gain of 5.36%, which you'll see in the future here was really, really good that I did. Then we move up here. Of course, it's going against me. We move up here, going against me. On Thursday, we had a big move down. What did I do? I took off another 2 profit targets, continually reducing my position size. And then Friday, we had a huge up move. Now, am I glad that I took profits on the way here? Am I glad that I got out of half of my short here? Am I glad that the day before this big up move on Friday, I took off another 2 profit targets at really good profitable levels? Absolutely. And that's why this is so important, in my opinion, to play offense and defense. And, if you'd like to learn more about this, I do teach private one-on-one lessons. I've taught people from all over the world, all the way from absolute beginners up to the hedge fund level and everywhere in between. I love to teach. I teach a great course. It's 15 hours, 5 sessions. Each session is 3 hours, and I teach you all the rules. I teach you all the strategies that I use. It's up to 7 now, so I teach 7 different strategies. So if you're interested, my email is in the link. Just send me an email and we can get the conversation started. Okay, so now the remaining shares that I have are still profitable slightly, about 0.83%. But if I had not taken these profits and had this process to follow, I would have been down here at almost a 7% gain, and now I only have a 0.83% gain. It will be very, very frustrating, right? You've probably been there. But that's why, in my opinion, it's so important to take partial profits as it goes your way. And then here, this was a great move, getting out of half down here. So yes, the remaining shares only up 0.83%, but up a lot more on the trade because of that offensive part of the trade. So I hope that makes sense. So PayPal right now, remaining shares on the short up 0.83%. Let's go over to TLT. Okay, so TLT, you can see the highlighted blue box here. What is this called? This is called an abandoned baby. So I have a video on YouTube called "Why Abandoned Babies and Island Reversals Are Some of My Favorite New Trading Setups," and that really is true. Go and check that out. It's totally free on my YouTube channel. But okay, so what's an abandoned baby? Abandoned baby, you can see the highlighted blue box. Do you see how we gap down? And then the very next day we gapped up. So there was sentiment, bad negative sentiment for whatever reason that was, news or reports or whatever, gaps down. And then immediately gaps up. So there was a bearish structure, or there was bearish sentiment immediately followed by bullish sentiment. That's important because as long as I've been using these, it really shows you when you see a dramatic change from this way to that way, and it could be very bullish up to very bearish as well. Like right here, these two bars here, it's what's called an island reversal. The difference between an island reversal and abandoned baby is just one. Island reversal is two or more. Look, we gapped up, everything really good, and we immediately gapped down. So sentiment went from bullish to immediately bearish. Was that negative island reversal a good short? It sure was. But to the upside now, this is why I took the trade. Gap down, gapped right back up. The very quick change in sentiment. So I just got done talking about playing offense and defense. In 90% of my trades, I play offense and defense. But these fair value gaps, these abandoned babies and island reversals, in my opinion, are really so strong that I want to give them a little bit more breathing room. And I like to diversify the approaches that I take. So when I take an abandoned baby or a island reversal, it's really quite simple what I do. I entered here 88.60. I position size correctly, and all I do if I'm bullish is I place a 2 ATR stop and a 4 ATR profit target, and that's it. So this is more of a position trade. Again, because these abandoned babies and these island reversals, in my opinion, are so strong. So I'm either going to lose 1% of my account or I'm going to make 2% of my account. That's it. It's either going to do one or the two, and I don't have to do anything. I just sit here. I have my stop here in the system. If it hits there, unfortunately, I lose. I lose 1%, or if I'm right, I make 2%. And in my experience, the win rate on these island reversals and these abandoned babies are about 70%, in my experience. So what does that mean? When I take a trade, 70% of the time I'm going to win. But most importantly, 70% of the time, I'm going to win more than I lose, right? If you flipped a coin and you had some kind of coin where you won 70% of the time, you'd still do really, really well, right? Because if you win $1. If you lose $1, but you win 70% of the time, you'd make money forever doing that. But this is even better because in my experience, 70% of the time these win, but when you win, you lose $1. When you lose $1, and when you win $2. So 30% of the time you're going to lose $1. 70% of the time you're going to win $2. That's a pretty good proposition, right? Well, this is exactly what these are. They don't win all the time. I lose on these often. But the important part is when I lose less than when I win. And I lose less than when I win, right? So when I lose $1. When I win $2. All right. So this particular trade is currently underwater, 0.39%. Not a big deal. But, interestingly enough, and it kind of reinforces this particular trade, do you see how Friday we created another abandoned baby? Look, Wednesday we gap down. Friday we gap up. So now we have two abandoned babies here. So I think that strengthens my case on this particular trade. But we'll see. We'll see. But this one down 0.39%. I did want to show you. So TLT is there's a lot of talk about interest rates and if they're going higher and so forth and so on. Okay, TLT here. Obviously, I feel like it's going to go up, right? Based upon my strategy. If the price of TLT goes up, then interest rates go down. If the price of bonds go down, then interest rates go up, right? I'm betting on this trade that yields are going to fall and prices are going to go up. But I want to show you over here on the 10-year yield. Okay, this is a yield, not the price. We talked about fair value gaps. Now, let's take a look here. We have a high, followed by another high. Then we have a dramatic break in structure to the downside. And was that, or in other words, yields going down? Did that break come to fruition? It sure did. Interest rates went way down. Well, now, look, we are coming all the way back up into that fair value gap, that bearish fair value gap. So my contention, I mean, if I was just trading this and I didn't know what it was, I would look at this and go, well, that's a short. Why is it a short? Well, because this moved down and then this moved back up into this major fair value gap. More likely than not, I could be wrong, but more likely than not, this is about as high as yields are going to go. And my contention is they are going to go down. So when I saw this 10-year yield, I went, oh, well, more times than not, when they get back up into this fair value gap, the yields are going to go down, which in other words, TLT, the bond prices, are going to go up. So I'm actually very bullish on bonds, and not just because I took this trade, but just a lot of things. You know, I study economics and you know, like to look at all the drivers in the economy, and so yeah, my contention is bonds are going to go up, but I could be wrong. I could be 100% wrong, and that's why I have my stop here. And if it hits my stop, I'll just get out, and I was wrong, and that's it. I'll wait for another signal. Okay, and then Adobe. All right, I did take Adobe on Friday. Now, why did I take Adobe? Multiple reasons. Big picture, let's take a look. There's something called the double bottom with the bullish divergence. This incorporates the MACD. It's the green lines here, or I'm sorry, the red lines here, and the green lines here. So, you know, one of the strategies that I teach in my one-on-one course is called the double bottom bullish divergence. I learned this from studying one-on-one with Dr. Alexander Elder. A double bottom bullish divergence occurs when you have a low. See the low we have here? See how deep the red MACD bars are? And then we have a bit of a rally, which turns the MACD green, and then we go lower. Are we lower here than we are over here? We certainly are. But do you see how the red MACD is very shallow? All this means is when you see more shallow MACD bars compared to the previous low, is that you're running out of momentum to the downside. Or in other words, you're running out of sellers. And if you run out of sellers, the implication is that you're going to go up. And that's what happens. When you run out of sellers, the price goes up. When you run out of buyers, it goes down. So big picture, beautiful double bottom bullish MACD divergence. Is that the reason to take the trade? No, that's just the big picture setup, right? It means this looks good, but I need an entry to get into the trade. I need a trigger to get into the trade and structure my trade. Well, here it came on Friday. What we have here is called a higher low V2 in the value zone. You have the green bar here, the green line here, the green line here. All this is called the value zone. And in my course, I teach two types. I teach a return to value V1, V2, and I teach a higher low V1, V2. This is a higher low, which means that you closed below the value zone, you came into the value zone, you pulled back, and then you created a V1 or a V2. Here's a V2. If you'd like to learn more about V1s, V2s, just go to my YouTube channel. I have a really good video on there that explains what they are, what the rules are, and so forth. But in this case, a V2 consists of 3 bars: bar 1, bar 2, bar 3. Bar 1, bar 2 has to go below the low of bar 1's low. Bar 3 has to close above bar 1's close, and it did, barely. The close was 477.12. We closed at 477.56. So I did enter. And one of my favorite setups really is exactly what happened here. You have a higher low V1 or V2 that's preceded by a double bottom bullish divergence. So it has everything: double bottom bullish divergence, a higher low V2 in the value zone. So I got long here at 477.31. I position size correctly. I placed my emergency stop how far below? That's right, 2 ATRs below. If I get there, how much will I lose? 1% of my trading capital. What percent of the time are you going to hit your emergency stop? Only about 5% of the time. 95% of the time, if you have a loss, it will be your end-of-day loss. And the end-of-day loss on a V2 is a close below halfway of the washout bar, or in this case, bar 2, 1, 2, 3. Half of this bar here, where you have this, I should probably make that a red line, huh? Okay, that's the red line. That's my line in the sand on this trade. If it closes below 470.10, I'm simply out of the trade. That tells me that I'm probably wrong on this trade. To the upside, I have placed my 1.5 ATR trailing stop level. If I get there, then I go into what's called trailing stop mode. And because this is a bullish trade, if I get there, then if I have a close below a previous bar's low, I will exit half. I bought this on Friday. If it moves up on Monday, where will I take a profit target? Where will I place my 3 profit targets? I'll take the closing price, add the value of the 0.45 to it, which is ironically 4.51. That'll be my first profit target. I'll take my first profit target, add it again, that's my second. Take my second, add it again, that's my third. So I'll have 3 profit targets on Monday. If I hit 1, great. If I hit 2, great. If I hit 3, that'd be really, really good, right? You know, most of the time you're going to hit 1 or 2. But what does that do? It reduces your position size, which reduces your overall risk, and it locks in profits, right? That's the offensive part. So, yeah, I like this setup. Who knows what's going to happen with it, but I do really quite like this setup. Higher low V2 preceded by a double bottom bullish divergence. I got in at 473.31. It's 477.31. It's 477.56. So basically break even at the time. But I really do like this trade. All right. So the recap on the daily trades. Remaining shares of PayPal up 0.83% on the short. TLT down 0.39% on the long, and Adobe right about break even. So nothing really to write home about here, although PayPal was a really, really good trade. In the process, my process lived up to the advertisement and really did help me lock in a really big gain down here before we had to move up. All right, let's go to weeklies. I also trade weekly bars. At the current time, I only have one particular trade, but it's a goodie. On Adobe, I was talking about a higher low V2, okay? And again, in my course, I teach both higher low V1, V2, and a return to value V1, V2. This is the weekly bars here on CCJ, Cameco Corporation, and this is the opposite. This is a return to value. Green line here, value zone. I don't like to buy over the value zone. I don't like to buy above value. I like to wait for the market to come back into value. And when it comes back into value, then I can consider getting long. Or with a deep dip buy, possibly a buying under value and selling in value. So the requirements on a return to value V1 or V2, first we have to close above the value zone, or in other words, we have to close above the green line. Did that, check. 2, we have to come back into the value zone. Did that, check. And then 3, third requirement is we need to have sideways motion. So we have to close above the value zone, come into the value zone, and then have sideways motion. Well, that all happened, right? Above the value zone, it came back down, and then we needed some sideways motion. When all 3 of those requirements are fulfilled, you still need a trigger to get you into the trade. What's the trigger? Well, the trigger was, in this case, a V2. Here we go. Bar 1, bar 2, bar 3. Bar 2 goes below the low of bar 1. Bar 3 closes up bar 1's close. I got long, 42.80. I position size correctly, placed my emergency stop 2 ATRs below, and my stop is a close below halfway of the washout bar. Exactly like I just set up on Adobe. I place my 1.5 ATR trailing stop level above, and if it moves the value of 0.45 ATR from the previous bar's close, I get out of 10%, right? At each profit target. So got long 42.80. Next week went up a little bit, but nothing to write home about. Next week had a huge move up where I hit, I believe, 2 profit targets. Okay, took 20% of the position off, and I got to trailing stop level here at 48.10. All this means now is that if I have a close below a previous bar's low, I will get out of half. Next week, we went up even more. I took more profits off here at the top and kept reducing my position size. So we have not had a close below a previous bar's low after reaching trailing stop level. The trade is doing very, very well. From entry to current price, it's up 13.37%. Now, earnings are coming up on the 9th of May. Of course, if you've been watching this channel for a while, you know that I do not hold through earnings ever. It's a great way to make a lot of money quick, but it's also a great way to lose a lot of money quick. So regardless of where we are, up here or down here, whatever, I will exit the trade before earnings. So this weekly up 13.37%. And so that's it on the weeklies. You know, I have had a few viewers ask me every once in a while if I could please show some day trades. And so this was a good day trade. We've been talking about fair value gaps and things like that. This was a good sequence of trades that I had on Friday. These are the cues on the 5-minute bars. And you can see, I'll kind of show you my thinking here. You can see we have this high here, and then we made a higher high. But do you notice how even though we're going up and up and up and up and up and up, there are no green bars whatsoever? This is called the double top with a bearish divergence. And so this was very suspicious to me as we kept rallying and rallying and rallying and rallying up with no green MACD bars. That showed me that we were probably running out of buyers and therefore we were going to move down. But just because that's happening, I can't just randomly short. I need to wait for something to happen. Well, what I did was I drew this trend line from the bottom of this low to the bottom of this low. And I was just waiting for a break in the trend line. And then here we broke the trend line very strongly to the downside. Okay, so when we broke that trend line to the downside, normally you come back up before you head back down. And that's exactly what we did. And so I got short here at the end of this bar, right about 432.33. My stop on this was simply if it closed above this high, and that's all. So I waited for a trend line to be broken. It broke. It had that counter move back up, which it often does. My stop was very close, just to close above here. But you can see we moved. It was a great trade. I shorted here, and it did exactly what it was supposed to do, where it came down, 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 down. I took partial profits, partial profits along the way. And then here I got out of the remaining shares because we got to trailing stop level and had a close above the previous bar's close. I just got out of all the shares here. Now, I keep talking about those fair value gaps. Well, in addition, so once we had this breakdown here, we created another fair value gap from here to here. Here is bar one, here is bar one, here's bar two, here's bar three, the low of bar one, the high of bar three makes this blue shaded area, kind of what I was showing you on the 10-year yields. So I got short here, covered out. And then as we got back into that fair value gap, I knew that more than likely there would be some resistance there. And look, it was perfect. I got short here, again, 432.16, and as advertised, it failed there and all the way back down. I just covered at the end of the day. So that was like $1.10 to the downside here and $1.10 to the downside there. That was a really good trade. That was a lot of money just because I saw the move up here with the bearish divergence, and then I waited for a break, shorted the rally, covered. As it rallied back into that fair value gap, I shorted again, and worked out really well. So anyway, hopefully that's helpful for those that were asking me to take a look at some of the day trends. Okay, before we start taking a look at next week's setups, let's talk a little bit about trader psychology. This is from The Chartist on X or Twitter, at The Chartist. Great channel. I highly recommend that you follow. Let's see what The Chartist says today. One of the simplest secrets to trading success is to do the simple things well, which is uncommon. Or in other words, follow your process well, which is uncommon. It is uncommon for people to follow their process. I know that sounds counterintuitive. Why do we do it? I don't know. We're human. We're fallible. But that's why following the process is so important. So one of the simplest secrets to trading success is to do the simple things well, which is uncommon. Show up every day. Place your trades each day. Record and track results each day. Even do a little research at the end of the day. I do that every day. You'll be amazed at how far ahead you'll be a year from now. Small things done consistently. Or in other words, follow your process, the small things. Get out when you're supposed to. Take some profits when you're supposed to. Adhere to your emergency stop. Adhere to your end of day stop. You're not always going to be perfect. You're going to lose all the time. But it's so important to get a process that you can follow and just and just do it. Those are the small things. You'll be amazed at how far ahead you'll be a year from now. Small things done consistently. The great traders, Dunn, Eckhart, Kovner, Trout, Tudor Jones, they turn up every day. Yet staying the path, being there, ignoring the noise, these are uncommon. It is uncommon to just do things right. It is uncommon to follow your process. And this really stuck out to me here, ignoring the noise. What's that? The noise is what you're hearing on financial media, what you're hearing from other traders, what you're hear on news reports. It's more important, I'm telling you, technicals tell the story, but you'll get a disconnect between what the technicals are telling you and what the media is telling you. Think back to the bottom of the market. Looking back, was it smart to get long back there? It sure was, but if you take yourself back in time to that time, the media coverage of it was horrible. We're going down another 40%. We're going down another 50%. Well, if you just followed your signals, you just followed your rules, the technicals were telling you something else, right? So ignore the noise, focus on what the charts are telling you. Trust the charts, trust the technicals more than what you're hearing from other people or the news or whatever. All right, so one more time. One of the simplest secrets to trading success is to do simple things well, which is uncommon. Show up every day, place your trades every day, record and track results each day, even do a little research at the end of the day. You'll be amazed at how far ahead you'll be a year from now. Small things, done consistently. The great traders, Dunn, Eckhart, Kovner, Trout, Tudor Jones, they turn up every day, yet staying the path, being there, ignoring the noise, these are uncommon. So thank you very much to the Chartist. Please follow at the Chartist on X, and I hope that was helpful for you. Okay, let's turn to the potential trades for next week. Now, I have 8 different potentials here for next week. They're not there yet, but theoretically, all of these trades could trigger at the same time. Does that mean I would take all the trades? No, it doesn't. I only, usually, most of the time, I only take one trade per day on a daily swing trade, even if I have 5 of them that trigger at the same time. Why? A lot of different reasons, but I have found just taking the best one of the day makes sense. And how do you determine that? You know, if there's 5 or 8 that trigger on the same day, how do you narrow it down to the best? Well, again, this is something I teach in my one-on-one course, but it's very important to the way that I do it is I look at, okay, how many signals were there on that chart? How did it look on the higher time frame as well as the time frame that I'm trading on? Which one had the best risk to reward ratio? Which one which one's market strength was stronger relative to the market? This is how I go through and grade them. I'll give you a perfect example. Home Depot. This was a totally legitimate trade on Friday. Why? Well, we went under 30, over 30, and we had a V2. So this is any time of the day I could have taken this trade, but I liked the Adobe trade better because it had the double bottom bullish divergence followed by the higher low V2 and MACD was green. Okay, I struggled at the end of the day. Which one should I buy? Which one should I buy? Which one should I buy? Well, the double bottom with the bullish divergence and the higher low V2, in my experience, is a little bit better. But if we go back to Home Depot, if it wasn't for Adobe, I would have bought that in a second. In a second, under 30, over 30, V2 retested the 200-day moving average. MACD was not green, and that's kind of why I deferred over to Adobe. So why do I have it on here for next week? If we come back and retest this 200, and it gives me a little bit better risk to reward ratio, I'll take it. That was a completely legitimate trade. But like I said, the Adobe trade, all in all, was a little bit better than the Home Depot trade, and that's why I took it. So on Home Depot, if we come back, retest the 200 again, which is possible, and it gives me a little better risk to reward ratio, then I will consider getting long Home Depot. We'll see. Johnson & Johnson. Okay, I talked about double bottoms, bullish divergences. Well, I can see one is getting ready to form here. Look at the lows here. Look how deep the red MACD bars are. Then we rallied into green. If we come back down here and retest this 30 RSI, especially because this major divergence, this MACD divergence is forming, I would very likely get long Johnson & Johnson. Okay, so we're at 33.88 for a deep dip buy. The deep dip buy approach that I use, and under 30, over 30 would be a legitimate signal. And that coexisting with fact that if we come back down to the 30s and challenge these lows, we'll have a double bottom bullish divergence. That would make a lot of sense. That would make a lot of sense. And by the way, speaking of deep dip buys, I have a great deep dip buy course on udemy.com. It's very affordable. It's a great video lesson, 9.5 hours. You can get it on udemy.com and the links in the description. So I do like Johnson & Johnson here. You know, we had this rally, we had a pullback, but if we do come down in the future and challenge these lows, we will definitely have a double bottom and a bullish divergence and will be, and very likely, a rejection of the 30 RSI. So that is a potential as well. Microsoft. Okay, at the beginning of the podcast, I talked about abandoned babies. I talked about island reversals. Well, this is a massive abandoned baby, right? On Wednesday, we gapped down, boom, because of Netflix earnings. Gap down. On Friday, never mind, super bullish. So this is a big time bullish abandoned baby. So could I buy it here? I could, but I don't like how high it is. One of my favorite things to do with abandoned babies is when they form, if they're very close to the top of the abandoned baby, I'll buy them right away. But this was so high. What I'm waiting for on Microsoft, if and only if this happens, it doesn't have to happen, and it's probably unlikely that it will happen. But when you have an abandoned baby, a gap down and a gap up, if the price were to fill the gap, or in other words, go to the high of this abandoned baby in the middle right here, about $400, that would be an excellent place to buy. That's how I like to do my abandoned babies. Gap down, gap up, but the risk to reward ratio is not that great. And you have some overhead resistance up here as well. So I wouldn't buy Microsoft right here, but if it comes down and fills the gap at the abandoned baby at about roughly $400, then I would very likely take a long position in Microsoft and then just place my profit target 4 ATRs above and my stop loss 2 ATRs below. So, I'm going to go over some of the markets like the Qs and so forth when we get done with this here. And there is some overhead resistance. There's a lot of actually overhead resistance. And you'll see when I get to the Qs here that I'm looking for a short on the Qs. So I do think it is possible that the Qs will come back down because of what I'm just about to show you on the next chart here. But as far as Microsoft, yeah, if we come down, close the gap, that would be a very excellent place. All right, here are the Qs. Okay. Last week on the podcast, I highlighted the blue area down here. That was a fair value gap, a bullish fair value gap all the way back here from January, if you remember that. And I said that very likely if we get into this blue box, this would be likely near a bottom. Well, it was right. Look at that. It poked its head into that blue box 2 days and then just took off. All right. Well, now we have the same issue to the upside. You see the highlighted blue area here? This is a bearish fair value gap. I highlighted this big bar up before the move down. This is called an order block. An order block is the low of the last up bar before you have a change in structure. This changed the structure here and it did follow through. So I would not be surprised to see the Qs at least rally into this box. We may have another day or two or 3 or 4 or a week of up moves. But at that point, we are going to run into some major resistance. And the bottom of this fair value gap is 437.90. Am I going to wait until it gets to the bottom of that? Really, the price that I've identified as the short on the Qs is right here at 436.30. One, it's in this highlighted blue box. It's in the bearish fair value gap. But do you see this big bar down here? Well, if you have a big bar down, a lot of times you'll rally back to halfway of that big bar. And halfway of that big bar just happens to be at 436.30. So it's halfway of a big reversal bar and it's in the fair value gap. So that is the level that I am looking for. What is that? About $5.30 above. We could get there Monday with this crazy market, right? But that's what I'm looking for. And if it does get to that level, very likely I will initiate a short here at Dovetails with a 50-day moving average. So a lot of confluences here. I don't know. I mean, it may just get to the bottom of that fair value gap and then come back down and I would miss the trade, right? But that is really, I spent a lot of time on it last night identifying a level, but the bearish fair value gap, halfway of that big bar, 436.50 would make sense. If it keeps going up, you're going to probably find some resistance at the low of that fair value gap. But if I do take that trade at 436.30, my end-of-day stop would be the high of this order block. It's kind of a lot of range all the way up there, but anywhere from 436.30 all the way up to 446.50, massive areas of resistance. So that's for myself. This is what I decided. If we get to 436.30, that will be my short on the Q. So I'm telling you this, one, just explaining the trade, and two, just looking at the market in general. Yes, we had a lot of excitement with Google's earnings and Microsoft's earnings and so forth, but we are still in a bearish market structure. Even though everything was very exciting on Friday, in my opinion at least, we are still in a bearish market structure. We may go up a little bit further, but I think that's going to be it. And highlighting this of why I would short at this level. So are we going back to all-time highs here anytime soon? I don't think so. I could be wrong. I'm just following my technicals. So again, on Qs, if we get to 436.30, that would be the beginning of my potential short position, and my stop would be a close above the order block here at 446.50. Let's go to the SPY. Same thing, very similar. Here is the bottom of the value gap, of the order block. Here is the high of the order block. Shortable, actually, anywhere from 511.90, but same with the Qs. I see the big downward bar here, halfway of that, 418.80. That's still 10 points above us. So I'm going to be very patient because this market is very resilient. But I believe somewhere in the blue area between 519.50 and 511.90 is the shortable area. But it makes the most sense because we have the big down bar here, halfway here, 518.10 would be my potential short here. Stops a little bit closer here at the swing high at 520.80. So as you can see, in my opinion, this rally may extend itself for another few days or a week, but I think that'll be it, because if we do that, we're going to be up into these major resistance levels. Unity Software. Okay. A lot of actually bullish things about this chart here. On Friday, we moved up. We took out this swing high. This changes it into a bullish market structure. We've been in a bearish market structure for a long time. Friday changed that into a bullish market structure. Does that mean I'm just going to go ahead and buy this? No, I am looking. See this bottom bar here? The top of that bottom bar is the high of the bullish order block. So if and only if we get back to about 2310, I would consider getting long here, because market structure has changed. A lot of time after market structure changed to the upside, it does pull back before it has another move up. And so that's my level on you. Very simple. Bottom of the order block, 2310 makes a lot of sense because we changed market structure. If I'm wrong, if it makes a new low below 2239, I'll simply get out of the trade. So I don't know if I'm going to get this trade or not. This was quite bullish, but again, if we do come back and test that 2310 level, that I certainly would be considering taking U, which is Udemy VIX. Okay, so as I mentioned about the Qs and the SPY, I think it's likely that we could rally for a few more days or a week, but then that rally is going to come to an end. That hypothesis is kind of strengthened by looking at the VIX chart. Well, of course, VIX had that big move up when the market rallied. VIX has collapsed here, but I don't think we have seen the end of VIX. I have a line here at 1307. What am I pointing to? Well, that's the high of this down bar before we change market structure to the upside. So if we get down to 1307, I will consider getting long VIX because it's the high of the order block over here. If it makes a new low, okay, I'm simply out. But if VIX does come down to 1307, there's a good chance it will rally. So it can still come down further, And what will the market do? If the VIX comes down here, very likely the market will keep rallying. But see, they dovetail together. If VIX comes down here, in my opinion, in my experience, VIX will bounce here or find a bottom. And so conversely, the market will probably come down. So if VIX comes down here, moves up, the market's most likely going to move down. And so that, like I said, it kind of strengthens my hypothesis about us being able to move up a little bit more on the market, but then have another down move. And on this VIX trade, if the market moves up, VIX will probably come back down to about this level before it bounces. So I'm looking for potential entry long on VIX at 1307. And then last but not least is XLF. Okay, well, this is a very textbook bearish fair value gap. Look, we have a high here. We make another high here. This breaks structure to the downside. It rallies like it often does back into the fair value gap and failed as advertised. Now there's a fair value gap here between 41.28 and 41.55. So this is the area that I'm looking to short because we are in a downtrend. If we come back into this fair value gap anywhere between 41.28 and 41.55, I will consider, see, here's bar 1, bar 2, bar 3, right in between here and here where I've highlighted in the blue is the bearish fair value gap. So I will consider getting short XLF here between 41.55 and 41.28. My stop would be a close above this high. All right. So you can see almost all of the charts that I'm showing you here kind of reiterate the same thing, that yes, we're having this rally, but this rally is running into a lot of resistance levels. All right. So anyway, I hope that was helpful on the daily. And if it was, like I said, if you could hit the thumbs up button, I really would appreciate it. It really does help the channel, helps keep the channel around, lets YouTube know there's some valuable content here. Again, on the weeklies, and again, on the weeklies, everyone, I have 3. It's potential. It's certainly possible that all 3 of these could trigger at the same time. But just like I only take one swing trade per day, the best one, I'm only going to take one weekly trade as well. Okay, I'm going to narrow it down to the very best one. The best one has the most confluence of signals, the best risk to reward ratio. It looks its higher time frame is at some type of support or some type of resistance, and I also factor in the relative strength. And again, everyone, I teach this all in my private one-on-one lessons. You know, if you're interested, please contact me. I really love to teach. I will teach you everything I know. You're going to learn a lot. You're going to be a much better trader. The course does cost $1,750, but trust me, it is worth every penny. One-on-one's the best way to learn anything, and that's why I structure these courses. And I do the courses via Skype and in the evening time. We also record them so that you have everything there that you can review back. But yeah, consider it. I think you'd be very, very glad that you did. Okay, BABA. All right. Well, BABA, I mean, look at it on the daily. The daily, nobody wanted it. Look at this ion reversal, by the way. Gap up, gap down. Nailed it. Down. Now we're all the way back up. So on the daily, we're a little overbought, but we have changed market structure to the upside. So this is what my thinking is on Alibaba. I think it's a little stretched at the moment. We have changed market structure this last week. Look, here's a high. We have a higher high, or essentially we have a high followed by a low and a low. We broke it to the upside. This changed market structure to the upside. So now I want to buy a dip. If you've been in a bearish mode and now you change market structure to the upside, now buy the dips, right? The old saying, buy dips in an uptrend, sell rips or sell rallies in a downtrend. Well, we have just changed market structure to the upside, so I want to buy a dip. The most reasonable place to buy a dip on Alibaba would be here at $72 at the high of the order block. Remember, order blocks, a bullish order block's the biggest down bar right before a market structure change. Well, that's exactly what happened. Down bar, market structure change. So the high of that down bar, the order block would be the reasonable place to buy. I don't know if it's going to get there. If it does, I will certainly buy it. And then I would certainly consider buying it. And then my stop would just be a close below here, because then I would change market structure again to the downside. So pretty easy, Alibaba. If we pull back to $72, I'm certainly going to consider getting long Alibaba. The Dow. Okay, well, I sound like a broken record, but I'm looking for a short. I'm looking for a short on Dow. Okay, why? Look, here we have a high, then we pull back. We make a higher high. And then 2 weeks ago, here, we took out the swing low. This changed the market structure to the downside. What do you do when you change market structure to the downside? You sell the rips, or you short the rips, or you short the rallies. Okay, where is that area for me? That area is in this fair value gap. Bar 1, bar 2, bar 3, low of bar 1, high of bar 3. I've highlighted here in the blue. Don't know if we're going to get back up there, but if we do get back up there, I will very likely short the Dow. My stop will just be a close above this high, or in other words, if it just breaks out to all-time highs again, that of course changes the market structure to the upside. But I like this trade very much. It still may have some gas in the tank, right? So I'm going to be very, very, very patient, and I'm not even going to think about shorting the Dow unless we get to 390.20. But if we do, it's very likely that I will short, because that is a perfect high followed by a move down, higher high, break in market structure to the downside. And so if we rally back up into the fair value gap while the structure is negative, in my opinion, that's the right thing to do. So we'll see what happens. And then last but not least, UNG. Okay, UNG. I've talked a little bit about, or quite a lot actually, about double bottoms, bullish divergences. Well, we're going lower, we're going lower, we're going lower. MACD green, even though we're going lower, not very deep at all. And here we have what's called the double bottom bullish divergence, missing right shoulder. Look at this low here, red bars. We are now lower, no red bars whatsoever. That's even more bullish when you have this double bottom bullish divergence and missing right shoulder without any red MACD bars. But just because this is in place, it doesn't mean it's the right time to buy for me yet. I still need a trigger. Well, the trigger for me would just be an under 30 over 30, right? Just what I teach in my courses, just what I teach in my deep dip buy course. Under 30 over 30 is one of the triggers, but it's a better trigger when you have double bottom bullish divergence. So I don't know what UNG is going to do. Possibly it goes under 30 over 30. If it does, I'll consider taking the trade. If it doesn't, I just won't take the trade. All right. So anyway, I hope that was helpful. As you can see, I am a little bit. I do feel like the market has a chance to rally, but I think that rally is going to be short-lived. I really do like bonds. I feel like we are getting close to the high of interest rates. I could be completely wrong, but technically, that's what I'm hearing. And you might say, well, hey, if bonds, if yields come down, then wouldn't that be good for the stock market? Sometimes not. Sometimes yields go down, market loves it and rallies. Sometimes, if economic indicators start to get bad, if the economy starts slowing down, yields could come down and the market can come down, because then money piling into bonds would not be interest rate related, it would be safety related. All right, so anyway, just a little economics laid on top of the technicals and so forth. So anyway, appreciate you coming today. Like I said, if you're interested in one-on-one lessons, I would love to teach you everything I know. I've taught so many people around the world, and I know they're really glad they took the course. So just contact me. If you do contact me, we start off with just a free Skype call, just to get to know each other a little bit. I'd like to learn more about you and your trading, and maybe your trading challenges, your goals. It's a great time for you to ask me any questions about the course. And then once we're done with our initial talk, then it's all up to you. Don't put any pressure on whatsoever. And when we're done, then you're going to have to call back or write back and say, Greg, I'm ready for the course. And I hope you do, because then we'll get started and I will teach you everything I know. If you're not in the financial position to take the one-on-one course, like I said, I have a great course on udemy.com. It's very affordable. It's somewhere between $12 and $40, depending on the day. I don't have any control of the price. That's udemy.com. But that course is 9.5 hours. I have 26 videos on there, and I teach you step by step exactly every part of the process of trading the deep dip buy approach using the 30 RSI, the 200-day moving average, the 250, and the 300. It's a great place to get started. And like I said, the link's there. Again, if you like the podcast today, I would appreciate if you hit the thumbs up button. It really does help out the channel. And most importantly, everyone, please try to go out and do something nice for someone today. If we all did one nice thing for each other, it really would make the world a better place. And certainly this world could use a little improvement. And if I could ask you one more favor, if you could go out and do something nice for animal today, I would really appreciate that. I'm a big animal lover, and they appreciate acts of kindness just as much. So please be careful next week. Yes, we may continue to rally, but like I've said throughout this podcast, I think it's going to be short-lived. So whatever you do, follow your process, follow your rules, do the things you're supposed to do daily, and God willing, I will see you next week, and we'll see what happens to all this crazy market. But thanks again. Appreciate you being here. Have a great and fun, safe weekend. And on the way out, I have to run the U.S. legal disclaimer. Thanks a lot, everyone. Take care. Bye.
U.S. government stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.